Then now, again, quick recap of what we did. You remember we set the scene. We started now what seemed to be a long time ago, a month ago, about our production pattern. We spoke about intermittence. We spoke about the fact that it was difficult to predict, and then we spoke about the risk, and then we spoke about risk mitigations. Then just now we touched on the mandate letter, due diligence, and so on. And now we are getting to the heart of our project finance on the structuring with the financial model, which almost is the essence of your expertise at the end of the day. This will be at the heart of your negotiation or discussion. Could it be internally or with your client? Now, we made a survey or kind of check yesterday who is familiar with the financial model. I'm sure it's many more people than those that raised their hands yesterday. Who again is not only elaborating, and the first question is getting financial models from clients. And yeah, I'm sure in Croatia and in the Netherlands and everywhere in Rwanda for sure. Have you seen, and I'm sure VDSA also, you are familiar with it, then you know financial model. Now the question is that you might be getting it from your clients very often. And then what we will be doing here, we will show what you should expect from your client or from your team internally if you are not developing the model yourselves. Might be in your bank, there is somebody doing it, and then there will be specific tweaks that you will be asking for when this model is developed. So now, what are the objectives now? In fact, it's to go through the kind of generic, I would say, settings or standard for financial models, and then get into the specific features that we will be implementing. And then together, we will run some sensitivity analysis, and after it will be your turn, and then we will try to play with the model. Hopefully, it shouldn't derail, but there is always a chance that by pushing a bit the financing, you will see some flags turning red, showing you that there is an issue with the project finance, but hopefully it won't be the case. Then now, our questions will be, what do we expect from a financial model? What will be the requirements that we will be imposing so that we could perform our analysis? And then what are the kind of sound and transparent operation of such a financial model? Now, what are the objectives and the purpose of a financial model? Then it's in fact to what we say ascertain the base case. And basically what you would like to do is to feed into the model whatever assumption you have. This is my financing plan, and make sure that it addresses the need of the project. And then you will build what we call, and this is the buzzwords, assumptions, which are inputs, but in a fancy way, and base case, which is whatever you present to your management, saying, look, this is what I am offering to finance, and this is my base case. So now, very important for you, and goes back to blending. When you blend, you must have a single model. Or if it's not a single agreed, at least, obviously, you must feed with into your model all the facilities, because otherwise you have a discrepancy and somebody is coming with these terms, but you haven't modelized the right terms, then you end up with a different conclusion. In an ideal world, not always easy, but I see more and more cases where the financial model is part of the legal documents, and there is even an external independent entity which updates the model for all the lenders, so that there isn't like any issue about who is doing what. It's a separate entity, and there is a single model. Not only is it more convenient for all lenders, but there might even be a kind of legal obligation if you have some ratios that calculate forward. Then there are ratios like the long life coverage ratio, whereby you put in perspective the future cash flow with the amount of debt left. Obviously, you are doing that on the basis of forecast. This forecast must be agreed among lenders. Then if you have different people working on different assumptions, you end up having a ratio which is either in met or in default. Then more and more, for complex cases or where you have several lenders, would you have a common model for everybody? And with this model, you will perform sensitivity analysis, which is a principle of stressing your model to check whether you are still able to finance or not. And in the case you have now, you would see that I set up like flags, which turn red or are blue if things are okay. And then you will see whether we could build downside cases or upside scenarios. Upside, obviously, always things are getting better, but downside is more important to check up to where we could go in case of interest rate being changed or price of electricity changing on this type of things. And now you will also use it to check that your financial covenant are reasonable. Goes back to one possibly downside of having a DSCR to sculpt the debt. In essence, your model has been designed to meet a DSCR, let's say, of 1, 2. Obviously, if you test whether your project meet 1 or 1.15, yeah, it will, because you design your debt accordingly. But still, in an ideal world, you will somehow distance yourselves from the debt that you sculpted, and then make sure that if you were to test a downside scenario, your level of covenant is reasonable or not. And then this is what you will be doing with your model, to agree on a set of covenant which is more or less reasonable. Bearing in mind that a covenant, as you may be practicing them, has two purposes. The first purpose is to send you a warning, because as a lender, you don't want a default. It's a nightmare. Don't do it. However, you want a signal that tells you, oh, this project is not doing well. And then you need the covenant to step in to give you rights so that you could intervene. But don't get wrong, a covenant is first a signal that tells you in advance that something is not doing well. You might even legally have this principle, I don't know if you're familiar with it, called potential event of default, which then become an event of default. But whatever early warning you've got, allow you to sort the problem out and then hopefully restore the situation. Because distressed assets goes sometimes in a different team, then it's very difficult to recover. You might also create a cross default with other lenders, but also other projects with the same sponsor, then no point getting a default. Now, what financial model must be? First, they must be transparent and auditable and this is where, then this is good. Then the idea is that in a financial model, when you receive it from your client or when you ask internally somebody to help you, make sure that there is a clear distinction between or among inputs, calculation here, and outputs. It's very important because the person that prepare it, in Excel in particular, must appreciate that you are not in his or her brain. Then you must really set your standard as somehow the client, the one that asks for the model, so to make sure that when you read it, it's readable. Otherwise, you are, I won't say dead, but you are in trouble. Then hopefully we will have the second condition. Then now, it should be then organized into logical sections, whereby hopefully again here if I move to my other computer, you will have the different assumptions on the different inputs where you have the revenues, the cost, and the financing. And here, for the model I did myself, I really got back to the basics. But this is what you should be forcing your client to do, because we will come back to that later. Your client will dream to send you a model that you can't modify. And then you won't dare telling him, you know what, it's a nonsense. You will accept it. And then you realize that it's totally flawed, and that they play tricks with it, and they change the data or whatever. By being very blunt upfront, by saying, look, I want this model to follow this principle, it will be very helpful for you, because then you will be able to use it. It should be flexible and dynamic, and we will see that later in the way we structure it. Because in the way we will program the model, this one translates into direct instruction. And then it should be consistent in terms of time. Basically, kill, it's a bit too much, but be very tough on any analyst that start playing between years, semesters, trimesters, and then changing all the things throughout. Again, a nightmare for the future. Then, sounds very like basic, but it's a very important thing. And then you should have check on flags. I'll show you again what I've done for myself. Then these are my check on my flags here. And then you have a reporting that automatically tells you whether a condition is met or not. Then it should be like basic principle, very simple, very sound, and very straightforward. And then if we continue with the way we should modelize, there is an approach, I don't know if you're familiar with it, they try to conceptualize modeling by calling it a fast modeling, which means flexible, appropriate, structured, and transparent. But these are key principles that you shouldn't hesitate to impose on whoever you are working with. Goes back, by the way, to this mandate letter, you remember? If you have a mandate letter among lenders, you could say, look, I am one of the lenders, I want that. And this will be my requirement in the mandate letter. I don't want a kind of huge machinery I'm not getting into and I can't use in the future. What should it be? Then again, a set of very simple rules. Then first, then what we have here, we have a set of rules whereby we say avoid hard coding. Hard coding means that you force a data at a given value, in particular in the calculation thing. And then I will show you how it works, because the same will go for the formula on the design. So now, if I go to calculation, in the FAST methodology, if you calculate here, as you could notice, there is first a total consistency among all my formula. Although I'm changing years, I could show you here. And this model is with you, and then you could play with it. But as you could see, I am totally consistent among all the things. And there is also second rules. If I'm calling a cell, it's always a cell within the same sheet, so that I could read it. Or otherwise, are you familiar with names or not? Like here, so that I could read literally what the formula is. And then I don't need a PhD in finance to say, oh, this is O&M percentage of CapEx multiplied by CapEx divided by 2 plus 1 plus inflation cost. Then I don't want to make a survey who's familiar with it. But very, no, it's a very interesting and very powerful thing. Then you could use macro, Python, or whatever in Excel. But my suggestion is really to make it like, I won't say simple, but go into formula and to the name manager. Names is the ability Excel will give you when you have a range of figures or inputs to give a name, so that Excel knows that whatever comes into that column correspond to the name in that column. And the beauty of it ultimately is that you will be able to read your formula. Then play with the example which has been given to you. And so you could see how efficient it is and why it fits very well with the FAST methodology. The second, we should just make sure that we don't overcomplicate. You notice that my model, I'm not sure if it's even what half a meg, or it's like very, very small in size. You might receive 3, 4, 5 megabytes of models that goes all over the place, which are just over-engineered. Then again here, your requirement, simple. Otherwise, you can't read it. Might be on purpose, by the way, but make sure that it's not overcomplicated. Much complexity with the decision-making process. Here, we will play with it easily. Hopefully, I hope during the exercise, you will be able to yourselves, though you are not familiar, let's say 15 minutes ago with that model, hopefully you should be able to use it. Otherwise, throw it away and maybe throw the guy with it, but anyway. It should be structured, then one calculation per row, one time per column, and you use a clear separation, as we said, between inputs calculation and output. And finally, it should be very easy to understand or to audit. And sounds very basic, but use it as a tool on something you could specify in your mandate letter when you ask EY or whoever to do your financial model. Then very practical. Huh? Now, as we said, we will use it to structure our financing and to make the stress test as we indicated before. Now, how, at the end of the day, we spoke about financial model, but ultimately, what are we trying to do beyond doing the stress test? What will be the effective outputs from our model? Then we will use input data, and in fact, we will build through calculation everything in relation to operation, taxes, finance, and then CapEx, in order to, in fact, build our famous cash flow cascade that will be reflected in our calculation, so that ultimately we could have outputs that I show you now, which are in the form of P&L, cash flow statement, and balance sheet. And obviously, everything should balance, and cash flow should remain positive, because there is two ultimate tests that when I was getting a model, I will check straight away, which are first, cash flow must remain positive throughout, otherwise project doesn't work, and balance sheet must balance. Not all analysts have realized this constraint, which means that very often you will have to send back the model saying, look, don't send me a model which is not balancing because it makes no sense. Then this will be your requirements, and this will come as outputs. And in the model you have, there is a test that in fact check that cash flow remain positive throughout. Automatically in the test, if there is 1 year when the cash flow is negative, it will report a false. The same with the balance sheet. If 1 year it doesn't balance, it reports a fault, then automatically you will see that something is not doing well. And this is the control that you've got in inputs here, where you could see you have the balance sheet and the cash flow. Again, simple check, but crucial or critical if you want to ensure consistency in your financial model. What is to say, except than the output? Output should be normally presented in such a way that it's acceptable to your management. Then usually you will have a pace or an approach in your modeling where you will follow, for example, monthly production because it's very intermittent, as we said. However, management won't accept to have monthly balance sheet or monthly cash flow. Then you will have to reconcile all the year as it is done here, so that even if the model is built on a semi-annual, it reconciles automatically in year, so that you could directly extract that, put it in your document, and send it to management for approval. And then having this output, yes, hopefully will save you a lot of time. And as we said, this model is in effect calculating, it's not a fake one, and we could play with it in the next session. So now, what will be the typical sensitivity analysis that you will be performing? Then they will be, and then we will try a few of them in the exercise. There will be one on the CapEx. What about if my costs are increasing? Do I have enough debt to pay? Or if not, how much debt should I load into the project? How does it work with my PPA? Because PPA may not change. And this is unfortunate, and I might have to put more debt, but unfortunately, revenues might not be different. Then the same with OPEX, then we will load a bit more OPEX if we want, by saying that our O&M cost could be increased by a few %. Inflation, then it's built in the model, but I let you play with it because automatically could be inflated or not, then up to you. And then any change in VAT or tariff, because there is also a VAT feature into it. PPA will be the one we will test together. Then there is any change in the price of electricity, the resource, then here, I guess we will discover it with a test. And then that one, again, could be automatically tested with the model. And then you have a downgrading performance of your PV panels, again, must be featured, and the financing terms. You notice in these 8 boxes, I have already set whatever I want to test. So obviously, this one becomes your requirement to your analyst or to the other lenders by saying, you know what, these are the scenarios I would like to test. Because if you are not telling that in advance, they won't build the model to allow you to change, you see. So in fact, unlike if I move to my inputs, in my inputs, as you could see, I have already preset all the variables that I could change. Now, if I didn't tell the guy before, everything will be hard-coded. Too late. Then, very important for you, when you develop a renewable project, to tell in advance, these are the scenarios I want to test. Then make sure that I could run sensitivity analysis, and make sure that you don't end up spending hours changing a model that at the end won't work any longer. Then very important that these scenarios, as we describe them, which are then back to where we were, then there was the one specific to infrastructure, then anyhow you must have these ones, but in addition for power project, you must have these ones, and then will come those specific to renewable, or was it before? But this one is almost renewable, which is the way you will ask the model to calculate or to profile your debt according to a given DSCR on a given PXX, P90 or P75. What is the benefit, and this is the ultimate purpose of a model, that by doing this profiling of debt, you will make sure that you optimize the debt structure, you are sure that you meet obviously your DSCR, because you made sure that the amount of debt is affordable for the project. And this is the best way for a renewable energy project to be structured. Then that one, and I could show you, although you will see that in the exercise, but there is a target DSCR, and what the model is doing, it takes all the debt available. We go almost through the famous cash waterfall, and then applying the DSCR, it calculates an amount of debt to be repaid, interest plus capital, that allow you to meet this DSCR. And it does it every 6 months. Then every 6 months, you take the cash, you take the cash, you take the cash to meet 1.2, which brings you to a point where debt is at 0. And then the question is, have you exceeded your tenor or not? Then have you ensured that you could repay within 10 or 15 years? And this is the way the model is taking the cash and somehow duplicating the principle of a cash waterfall that we described just before.
So, are there any questions?
Maybe that's like a mix of a question and a comment. So what we normally see, or what I got trained on in terms of these models, is that we would also separate the inputs from like the tests or like the sensitivity analysis. So, and I mean, this one you have not done it. Would you recommend it, or?
Oh, yeah. In fact, somehow what is happening is that to simplify the thing, I did put on the input so that you could see the impact, all the outcome from your test, because otherwise it would have been difficult for you to see what is done. But basically, what I was used to, like you, was input, calculation, output, and then a separate spreadsheet will come with a sensitivity analysis, or so that I make sure that I don't confuse the thing. However, in all fairness, it's true that to allow you in a kind of simplified way through that exercise to see the impact of any sensitivity, you will see that the table or the feedback from the sensitivity was unfortunately brought into inputs, which is not right. Well,
It's kind of a control we have added for the exercise, so that when we now in the exercise go to steps, that everyone can directly see the result of the sensitivity analysis.
Yeah.
As we said, LOD shared the link where we are storing all material, and there on the session 5, day 2, I think day 2 exercise. The important one is now the one with 03, and really please download it and rename it, for example, as step 1 or whatever, because we would really advise that you are always copying a step once we have done it. And then, so I think what you could do, you can either work alone or you can also work in pairs. It's up to you. And exactly, we have structured it along 4 steps, which I will explain, and Laurent is going in the room, so in case you have any questions, just raise your hand and we'll discuss them really one after the other.
And I do the sensitivity on the interest first?
Oh yeah, you're right, I was too early.
No.
No, let's do this first.
Yeah. Then we have one that we purposely did ourselves, which is the one on the interest rate. The reason is that I wasn't too sure if all of you were familiar with what-if analysis. Anyway, the idea was, in case you are not familiar with it, this function is very good in a sense that it allows you, without changing one after the other an input, to use a kind of table or array of data that you create, which is this one. You ask the model to tell you what is the output of a given cell or calculation for each of these inputs. So basically what we've done here, we use the interest rate on one facility, which is set here in that cell. And then we tell Excel, could you please tell me what will be the return on equity if I was to change the interest rate. And then this is a return of equity, and then this is the internal rate of return of the project, so that you could compare, because obviously one is lower than the other, because this one is loaded with debt. This one is only equity, so it's just to match. One is obviously higher than the other. And then you tell Excel, could you please tell me what is happening? And then what if takes this data, and then you automatically get the result. And if I show you the way that thing works, then you will be difficult to manage, but it's like doing that, and then you select and you do the what if, and then you go table data and you point at the output that you are looking for, and then automatically it will tell you what to calculate. And I could go to, then because all my data are in column, I click on column, then I will tell Excel, column here is my percentage, and Excel will know automatically that it must calculate what was here. And what was here, I just cut and paste return on equity. And automatically Excel knows that, hey, this was return on equity, then he must be interested to know what is happening with 3% on return on equity. And it provides you everything. Then what if is very convenient because then no need to get to the pain of putting 1, 1, 1, 2, 1, oops, and it provides you everything. Now, what is interesting for us is to look at how it ended up. And no surprise here, if I start increasing my interest rate on one facility, my return on equity goes down, which is good news. Good news not for the investor, but good news for the financial model. Now, what we will be doing, we will not do what if here, because we will be looking at something different, and possibly this is where Christine will step in with the instructions, because we will only change one variable with one input, and then the idea will be to check what is the consequence on our debt profile. Because you remember what we wanted to do was to try to find the consequences of having different facilities, and what is the room we could be giving to a junior guy because of the cash and the way we generate the cash. And you will see in the chart that we will show the various amount of money available for one or the other.
So basically the idea of the exercise, and we hope it works for everyone, although like I think the differences among the group is quite different, is to test a bit like the project sensitivity to lower and higher interest rates and the deferment of debt repayment to reflect the subordination. And the other one is to think about like debt repayment profiles which materialize to the lender, to the exposure to the project over the time. And basically our base case, it's what we have, you will see also in the Excel file somewhere a bit like, I think a bit lower on the right side. You should look like this at the beginning.
So two facilities are one above the other in terms of exposure because they are set today at the same level, same tenor, same grace, same interest. So no surprise, the two facilities, 1 and 2, are one above the other with the same profile. And here, this is the deposit, because at the time, the model is not providing for any dividend. We assume that the money is there. Then one will think, look, whatever deposit, sponsor will think that it's in his pocket. But as you could notice now, in a best case, we are piling up cash already. Then one will think, what do we do with this money? And goes back to, you remember, this business of junior facility, this idea of ensuring that the cash return is reasonable for the sponsor, because what we will try to do is to siphon that money so to make sure that we could have a more balanced approach vis-à-vis each of the party. And this is what we will start doing with the various tests.
So the first step is to change in the PXX scenario, the scenario from P90 to P75. We have been really nice, also directly allocating the cell. And what we would we have also in parallel this Word document to download. This is just the idea that we want you to really store the different results of the figure over the steps that we can really also see then for the discussions later.
And move the chart so that you could see by yourselves already the impact it is having on your debt profile. Because this is quite surprising. And then have a look as well at your return on equity and the internal rate of return, because it will be boosted straight away. I think we start from P90, moving to P75. Then you will be surprised to see how much cash you are making.
Does it work?
Does it work, yeah? Or
so, Laurent, over to you.
Yeah. What happened, hopefully, if you move your chart...
or maybe you can tell.
Yes, you
Yeah.
can tell. Who wants
So
to tell?
who wants to tell what was the observation?
Well,
So we noticed that the curve is a bit steeper. So like, yeah, the facility 1 and 2, actually a bit steeper. So probably more revenues in a shorter time period. So we kind of said that it was also probably a bit less risky because we had
Sure.
more revenue faster.
Yeah. However, as a consequence here, what will have been interesting also to notice is because you got the same amount of financing being made available, so you generate more cash. So normally that thing should have gone from here to there. Then basically your exposure as a lender should have decreased over time somehow, because if you compare P90, you generate, let's say, 100. In P75, you generate 110. Then this little additional money allow you to get your cash earlier. But in total, you generate more cash. No doubt. Yeah. And you notice that this is a kind of real assumptions. These projects are cash machine. And if you realize, back to what we were saying, squeeze the sponsor, not to be too tough, but if you realize what are the real figures, they will always complain, life is tough, I mean, it's bullshit. At the end of the day, as soon as you get repaid, money is flowing. And that's why you have to check really how much money they will be making as soon as you get repaid, so that there is a fair share between you and them, and not being, as a lender, unreasonably exposed.
So we remain with the step 7, like with the P75. It's also, we are always now adding or changing just this one assumption. In this case is we are changing the interest rate from facility 2 from 6 to 8%. So it's cell 71. And again, we said why. So once you have done it, to really copy the figure, have a look at it, and also save another copy.
And I should tell you that the line that you are showing is a principal. It's not principal plus interest. And don't expect the two facility to be seen differently, because obviously the line show what exposure you have to a project. Then what you might see, it's interest growing, but the profile will remain the same. Just for you to warn you, so it's not principal plus interest, it's just principal.
Now for clarification, we have added on the left side, that's the one from the previous step. On the right side, it's the new one. So now you should have this one, and then I hand over. But first to see, did it work out? That's the old one, and that should be the now.
Yeah, then it's a small. I think funny thing, we could conclude two things. First, there is obviously a small increase in the total amount of interest. However, if you look at the general pattern of your financing, 2% for you as a lender is huge. I could imagine when you go to your management saying, hey, I squeeze more interest, they would say, hurrah. For the project, the impact is not that big, funny enough. Then you shouldn't be shy to force somehow not to be unreasonable, but the interest, because as you could see, for the overall dynamic of the project, the impact is not that high. And this was the thing to take into consideration.
So we again leave what we have already changed in the previous steps, but we are now changing the grace period again, talking about facility 2, from 3 years to 5 years. So you should already know, cell E65. And again, to maybe save it in between for step 3, to have a look what changed, and also have a small thought about what is the idea behind it. So Stefan, what's the observation you just learned or had before?
Well, since the second, or the orange facility is with a longer grace period, the blue one can be repaid faster, and therefore it has a lower risk basic profile, and then the orange one takes a higher interest as well. So the money in the bank for the developer is lower over time, as there's more interest paid over time to the at a higher rate to the second facility than the first. Yeah, that's the main observation.
What we did together, we also check the return on equity. And in fact, from that scenario to this one, it went down from 9.5 to 9.3. Because obviously you extract much more interest owing to the fact that you keep the debt here. And then as a consequence, you reduce the amount of cash that goes to the sponsor. Now, what is interesting goes back to blending. As you could see, by creating a facility for senior lenders, you almost ensure that you, senior, get repaid in a kind of shorter amount of time, then perfectly fine for you as a senior lender. And the junior guys will keep on hold, and then they should be remunerated for it because they are more exposed.
Is it normal that the senior lender total term is the same as the junior lender? Just the grace period is different? Is that normal?
The thing is that the way the model is working, we try to repay as quickly as possible. Now, you're right, we might have put a threshold under which junior lender must get the money or mustn't not get payment. And we could have said, look, you are junior, then at the end of the day, I want prepayment. Me, senior, you will prepay me before you, junior, get it. So this is all the dynamic you should agree with the junior lenders. At the end of the day, what it shows, just changing the grace, because there is also, you will notice in the model, a way where you could change the overall tenor. Then we could have added one step whereby we put one facility at 10 years, another one at 13 years. And if the cash is not sufficient, automatically junior will be pushed. But it's a matter of fine-tuning. I guess the message which is interesting here is that in renewable energy, there is room for various facilities, and we generate enough cash to afford a junior position. And there is many lenders that will be interested to take it, either because they have a mandate, like the EU-backed EIB facilities or whoever, or it could be people who have would like to support renewable energy development in their own countries. Then there is a slice of senior debt, fully secured, and with a very, I would say, secured repayment, whilst junior are taking more exposure to the project. But your point is right, might be, it's a bit risky, but offline, what you could be doing, it's to play with the tenor and to check what is happening. Huh? And if you are short of cash, meaning if you don't generate enough cash under a certain DSCR, the flag will turn red. Then you have to adjust either your tariff or your assumptions so that you turn back to blue. This is the way the model is working.
Good, then I think we go to the next step. It's also the last step. So again, we are leaving the previous step, and now we are changing the DSCR from 1.1 to 1.05. This is cell 90.
And you remember, this is a DSCR for equity lockup. Huh? Then it's not the overall DSCR under which we profile our debt. It's the one which apply to the sponsor, under which condition they will extract the money or not. One thing we noticed that it might be easier for you to check return on equity, which is sell whatever, next to the blue sales when you make that test. Because on the chart, it's not that obvious, but you will notice that you change DSCR lockup, look at return on equity, and you will go down, I think, from 9 something to something below, or the other way. You're right, up. You're right, the other way around. Yeah. But what is interesting is that it's so tiny, and still you are getting a 0.2 higher return on equity. And what happened, and then you can't see it on the chart, is that you just extract more money upfront, and it has a value. And that's what your sponsor will try to be doing, so that they could get the money as soon as possible. But what is interesting is that although, in fact, Christine, you got a point, because I guess, I don't know if you were like me, but I was only looking at the shape without realizing that the amount went down. And I thought, oh no, it's the same shape, I've got my deposit. But look, we went down from almost close to 4 to something where we are below 3. Then it shows that when you create a junior facility, interest went out, whatever we say. Because I realize now that, oh yeah, the shape is the same, they extract as much money as before. No, it wasn't the case. And as you could see here, the yellow line went down substantially by almost 25% from the best scenario to this one. But that one should, that one, which is scenario,
5 is the last one.
this one is 4, yeah. This one is should be the worst somewhere, yeah. Yeah. But the thing is that it helps compare. Huh? I'm still a bit surprised by this one, to be honest with you, the amount of deposit. Because, yes, we extracted, the thing is that we extracted cash outside the deposit, hence the consequence. Then we have to check the return on equity, which is the total amount, which include dividends plus deposit. This is it. But anyhow, conclusion, it's in the model. I haven't shown it. I should have possibly shown to you how much dividend we extract. If you play with the model, you will see that in calculation, cash flow, it will come as dividend, and then you have a line up. You
Do
could
you
include
want
it.
to show it? We can also switch to the model.
It's dangerous, huh? But yes, hola, calculation. Then if you are looking for amount of dividend being paid, here they are. Then I'm still having the old scenario. Huh? Then I have my lockup, and as you could see, it makes that I'm not extracting dividends before many conditions are met. I have fully met my DSCR for the debt. I start paying the debt, and only now will I try to extract a bit of cash. This is the model best case, huh? So that's why it doesn't take account of the changes you made. But it shows that if you have a dividend lockup, you prevent the sponsor from extracting money. Now, in our model, we keep the deposit very high. Huh? It's like a basket of money that should be reallocated normally. Huh? But here, to simplify, at the end of the project, both dividends and deposit goes to sponsor. You, as a lender, may say, no way, I want part of the deposit and I control it, cash sweep. Ups goes back to me. But the principle remain, the cash waterfall is somehow working, and you have first senior lenders, junior, then dividend, and then deposit, and you decide how to allocate them. And with this model, hopefully, it's simple enough so that you could play with it. If there is any, I would say, inconsistency in a sense that you don't have enough cash available, the flag will turn red. Then let's assume that you have not enough money to repay your facilities. Then it will tell you, look, the tenor of your facility is too short for me to be repaid. Then this will be in inputs. Here you will have either a problem with the duration, which is too short, or the tenor, which is it not sufficient to get repaid. And it turns. And these flags are very important. You remember, they are the ones that are critical when you ask anyone to prepare a model. That one will confirm that your balance sheet is balancing. Then you have got equity equal to liabilities. On this one, throughout the project, cash flow is positive. And what I was explaining to Leonardo, and I can't remember your first name, although we were on the phone many times, but is that when you build your cash flow, try to avoid the accounting presentation of the cash flow. but make it or present it as per a financial model, which consists of 3 cash flows in one. You first have your operating cash flow, which is the amount of revenues that you generate minus your cost. Then you take out all the rest, operating cash flow. You then have investment cash flow, and you then have financing cash flow. The sum of the 3 makes the total cash flow. Many, or very often, would accountant mix it. Then they will, for example, put in perspective investment and financing associated to this investment. It's good, but it's not ideal for us because we really need the 3 of them. Then operation, investment, and then financing. And the sum of the 3, bottom line, gives you the net cash flow at the end of the year. And this is the one that should be positive throughout. And if it's negative, it means that you need more investment, more financing. Sorry, not more investment, more financing. Then raise debt or delay repayment, but one or the other. And the idea of having a test where cash flow total must be positive throughout. If it's 1 year negative, send it back to whoever prepares the model. Tough life, huh? But they're well paid, then you shouldn't hesitate. Yeah, no, it's true. That's fact, yeah. Et voilà.